Hello.
Hello, Dimas.
Hello, hi, Adrian. Hi.
Okay, cool.
Okay. Is it clear?
So let me check if
Let me put in the slide as well. So give me 1 minute, yeah.
no problem.
Yeah, so Simon and I will be presenting from our conference room, so no issue about the link, I think. Yeah.
All right, yeah,
Yeah.
that's good.
Yeah.
Because now I can see. Have you tried? Can you try sharing a file?
Yeah.
In a while.
Yeah, I'm working. So sharing the slides, right?
Yeah.
Yeah. Can you see my screen?
Hold on. Oh yes, perfect.
Okay. Yep. All right.
All right. Yeah, currently in Singapore or in Europe.
In Singapore. So the
Okay.
management office are all in Singapore, but the property management teams are in Europe. Yeah.
So you all need to fly there quite often.
Um. Well, we have a lot of people on each of the countries that we operate. So the senior management, like Simon, usually go back to Europe like 3 times or 4 times every quarter, basically, just to take a look. Yeah.
3 to 4 times, almost like a monthly thing. Yeah, okay, not
Well,
bad.
yeah. Well, not monthly, maybe like every quarter or so. Yeah. Are we we are your first S-REIT, right? To be presenting in Vietnam.
You mean in terms of listed company?
In terms of presenting it for the webinar, we are the first Singapore REIT, right?
Oh yes, yes, yes.
Mhm.
And very unique because you guys are European REIT that are full European REIT, in fact.
Yeah,
Yeah,
that's
so
correct. Yeah.
but I want to manage a bit of expectations because ever since the pandemic has ended, right?
Mhm.
The traction for webinars has been not as easy to predict.
Understand. Yeah.
So I'm trying to do here uh or going forward is I'm trying to build a following and also attraction.
Right. Right.
But it's a building block, I must say. And I only landed this role recently to be able to try to do things the way I like. And
Right.
while we have periodic webinars with a lot of companies in the past,
Mhm.
I think going forward, I want to do something that is more consistent, something is more recurring,
Yeah.
because
Yeah.
that will hit people's habitual sense that they might be following something that they're interesting. So
That's correct.
then
Yeah.
it becomes second nature. So we are still in that phase of building up.
Understand.
So
Yeah.
just want to manage your expectation on the turnout.
Totally understand. Yeah. Totally understand. Yeah.
Yeah. But in the past, on
Mhm.
how I've conducted a webinar,
Yeah.
would be a bit more of like a forum like.
Okay.
But I think tonight I will leave Simon to finish his presentation before I move to Q&A.
Yes.
The experimental one that I tried with Jeff from SGX
Mhm. Oh, Jeff
is
have presented with Kananga. Jeff Howie, right?
yeah.
Ah, okay.
So
Okay. Yeah.
so we are having like our conversation like now
Mm-hmm.
throughout the night. So it become more like a chat from
Yeah.
Fire Talk, a podcast.
Yeah.
And somehow people stay till the end.
Okay. Okay. That's good. Good.
Yeah, but I think for company part of presentation or webinar, but I think best not for me to interrupt first, then we
Yeah.
go on a Q&A later.
Yeah. I think with Jeff, it's a little bit we can one can afford to be more free flow because he have a very broad topic, right? You can talk a lot of stuff. You can talk a lot of sectors, for example.
I
Not really. Was
actually
it?
I actually took the lead on the things that he's actually presenting, and
Okay.
I added on it.
Right.
I lead him to be a bit more in depth on his thought on why is he choosing things like that.
Okay.
But we didn't wait that for that session until the end. So
Right.
I just interjected and while he's actually presenting.
Right.
So far it turned out was quite good, I think.
Mm.
But with companies, I have never experimented it.
Yeah. I think
So
especially if it's the nature is more introduction, right? It's probably best to have the company explain
yes,
the about the company first, and then you can build upon that the points that you would like to
yes,
clarify, right? Yeah.
correct.
All right. Yeah.
Yeah, so that's where I think I will let Simon
Yeah.
to do most of the presentation tonight.
Yeah.
By the way, how do
So
I pronounce his full name? Simon Garing?
that's correct. Simon Garing. Yeah.
Garing, not Garing,
Yeah.
huh?
No, Garing.
Because I'm Malaysian, right? Garing,
Yeah,
Garing.
I studied in Malaysia. I studied in Monash, Malaysia. Yeah. So
Oh, okay, okay.
yeah.
And yourself is from
Indonesia. I'm Indonesian, but I did my undergrad in Monash in PJ. So in Sunway. Yeah.
oh,
So I'm very
okay.
familiar with Malaysia.
And you landed yourself a job in Singapore after that.
Yeah. I actually got an offer in Malaysia, but it was very difficult to get a visa, working
Foreign,
visa.
for a
Yeah.
foreigner, yeah, foreigner visa to for working.
Especially fresh graduate, right?
Yeah.
So it was very difficult, so I didn't get it. So next best option is Singapore. So yeah,
But how's the process in Singapore? Is it that difficult, or is
I
obviously it's
was
a lot easier, I think?
yeah, now it's quite difficult, but I was quite lucky because I moved when the economy was very good and the political situation was slightly different. So I moved in 2008. So they're very welcoming. Singapore very welcoming.
Oh.
It was very
Oh.
boom. It was booming time that time. Yeah.
So you have been in the IR or corporate finance for the longest time, or?
No. I was on the asset management side for a bit time. So IR is actually relatively new for me. Yeah. So I've only been in this area around like a year and a half or almost two. Yeah. You've been with Kenanga
So
for a
you are
while, right?
always a property REIT manager when you move there?
No. So the most of my professional time I was with PIMCO, which is a bond focused asset management firm.
Oh,
Yeah.
all right, yeah, I get it.
Real estate is relatively new for me as well. So a lot of learning experience.
Yeah, that's
Yeah.
very interesting.
Yeah. You've been in Kenanga with Kenanga for a while, is it?
12 years, I was
Oh
a
wow.
research analyst that
Okay.
covers, yeah, I was a research analyst that specializes in construction, property
Okay.
development, not too much on REIT. I do touch a
Mm.
bit, but I don't spend my time delve very deeply in the REIT.
Right.
I do cover the transport sector for a while also, like Asia, MAS,
Okay.
so Malaysia airports, yeah,
Mm.
all these names. So in terms, if you ask me on the construction scene in Malaysia, until today I'm
Yeah.
still rather well versed.
Right.
Um, but fast forward to 2019, I mean, I joined Kenanga in 2011.
Okay.
So as a research assistant, and I actually worked my way up.
Yeah.
And after that, I was a bit bored with what I'm doing because after a
Okay.
while, it's just a few statements, right? So
Yeah.
uh, my boss was looking to start a new department, which is quant and AI trading solutions.
Oh, okay.
I actually raised my hand and said, "Can I try
Right.
uh, to be a bit of a more of a marketing or sales in that sense?"
Yeah.
Yes, they gave me the opportunity, but it has evolved into something else now.
Yeah.
Now that I'm being pulled out of that department, that I
Uh-huh.
have a broader base of coverage
Yeah.
where I'm actually covering the entire bank's product and services,
Okay.
uh,
Okay.
marketing efforts. But because
Hmm.
of my expertise back then,
Hmm.
and also the license that I hold in Malaysia to be able to give investment to the public,
Yeah.
I am able to actually host talks
Okay. Okay.
and also give stock recommendations at the same time
Right.
without violating the regulation of our Securities Commission.
Okay. Okay.
So it is only natural that previously we have been outsourcing this kind of activities out,
Okay.
but now we are actually taking it in control and have
Yeah.
more activities. Yeah.
Right.
So if you do have a Kenanga account and if you happen to be interested in trading in Malaysian market,
Right.
you'll see me every Monday morning 8:30 that where I
Okay.
actually host a stock chat that I will throw in a few in that short 20 minute. I'll cover almost like 10 charts.
Okay. Okay.
Not all my picks makes money, but
Yeah.
so far the probability have been good. Just that this week the market has been rather brutal.
Right. Right.
Yeah, so this is where we come in from Kananga's perspective. Is this where we drive more value for our clients?
Yeah.
Yeah, more you're not just left there in the sea trying to find your own way in the investment scheme of things, right? So this is where we come in.
And you're even actually offering a diversification alternative for your investor base through the SGX link, right? So that they can invest in Singapore entities as well. Okay, let me call Simon maybe, if you don't mind. Yeah.
Yeah, sure.
Yeah, sure. He said he cannot. They have a condition for SGX rating. They currently control. They reach out to us and the SGX. Okay, yeah. Hey, Adrian.
Hello.
Just
Yeah.
just checking. Yeah, just checking with you. After the event, we will be able to have like a summary of how many people are participating, and
Yeah.
just brief a summary about the event, right? So that we can actually have an internal data as well about our engagement in
Yeah.
Malaysia.
Sure.
Okay, great.
Definitely.
Yeah. So Simon will be driving his own slide. So it will be using my computer here directly. I think it should.
Yeah. That would be good.
Yeah, it'll be easier, right? Yeah.
Yep. We can just keep the S-REIT very short. Yeah. Very short.
Yeah, correct. Yeah. So what's your initial take about us? Do you think we're attractive for Malaysian investors?
I would say it's definitely really a fresh perspective because
Yeah.
uh firstly I've never traveled down to Europe, or I have never had the time.
Yeah.
Now I'm actually looking at more from the lens of Cromwell
Mhm.
on how is the so-called trend is moving in terms of offices, and
Right.
how you guys are transforming and shying away from that kind of investment properties
Yeah.
into more of a logistics kind of a play,
That's correct.
industrial. But that also got me thinking at how would the consumer sentiment be like in Europe as compared to US?
Right.
Or on the base of the coverage, on looking at the logistic locations that you are actually looking into.
Yeah.
Because I do agree that the boom of logistics and also warehousing business that
Yeah.
is growing, and
Yeah.
eventually data centers.
Yeah. Oh,
So,
Simon's here. Yeah.
all right.
Yes.
Hi, Simon. Good
Hello,
evening.
is this Adrian?
Yeah,
Terrific. How are you doing?
doing quite
Good.
not too bad. Market
Good.
has been quite interesting, I must say.
Yeah,
We are trading in a very
him
interesting
about
time.
what his initial thought about Cromwell, whether if we're an interesting option for our Malaysian investors.
Yeah, it is one of the more interesting ones because it gives me a very an opportunity or a perspective of a region that I have never actually covered, and opportunities that lies ahead. Yeah, but of course, in that context, is what is intriguing is how would the management of Cromwell being effectively managing the REIT managers from all these countries. That is the interesting part. I mean,
Yeah.
it
Yeah,
is
we'll
where
address
the
that.
digital.
We'll address that. The company has been operating in Europe for well over 20 years.
Hmm.
And it has Finns in Finland and Poles in Poland and Germans in Germany. So it's a very broad but deep team. There's only 10 of us here in Singapore, so we are sort of the front, the fund manager, the CFO, Dimas and Elena on the
Yeah.
IR side, compliance, etc. But all the hard work is done by our team in Europe.
Yes, the heavy lifting.
Yes. And Kananga, tell me a little bit about who Kananga is, and because I haven't come across your organization before.
All right. Just a brief introduction. Kenanga is the largest independent investment bank in Malaysia. By the definition of independent is we do not. Kenanga is a standalone investment bank that does not have a commercial arm.
Uh-huh.
Where you
So
have your bank
a
deposits
good
and stuff.
old-fashioned stockbroker.
Yes, with investment banking capabilities and also license. So where we excel at is in the local scene, we actually have a very strong traction with our institutional investors, and also we have the largest market share in terms of retail participation. Yeah, so this is where we come in, where we help our clients to grow their wealth where we offer a one-stop. We are actually a one-stop provider in terms of what is financially regulated. So what we offer is from your asset management products until to the level of stockbroking, and even our IPO services in Malaysia, and also book buildings and all these services. So yes, a traditional stockbroker that is going digital. We also have our sister company called Rakuten.
Okay.
Rakuten Securities, that is a digital broker that is also expanding their presence. Is a 50% owned company between Kananga and Rakuten Japan. Yeah. So in terms of retail scene, we are taking the lead. But of course, I was sharing with Dimas that managing a bit on expectation since post-pandemic, the effort in getting crowds in webinar has not been a straight line in terms of prediction. So yeah, it all really depending on the user's preference of topic.
Yeah.
So while I'm in this role, I was an analyst in the research side of my company for the longest time. Now I'm on a new role on more on marketing, products, and even stocks. That's partly because I hold an investment advisory license. It allows me to speak a bit more freely on stock recommendation publicly. I am actually trying to build up a following on a periodic event. If can, I'm actually planning a recurring webinar that covers a very broad base of topic with a few anchor next year on a weekly basis, non-stop, on the same day. So
good.
it would build. I'm envisioning to go that part to build up a following. Is like you're actually going binge watching your so-called series. I want to make it a series. Then people will be more naturally in tune to follow the events of this series, regardless of topic. Then I will be able to build up a crowd.
Yes, and build up a franchise. I used to run research for Merrill Lynch through Asia Pacific.
Okay.
So my background is actually doing what you're doing.
All right. That's we're not too far in. All right. You're hating it. I started my career as a research analyst, and
so did I. I started off as an accountant, and then went to an Citibank as an investor, and then after 4 years got poached to go into the sell side, and then that was 1996.
Wow. And I was, where am I? Let me guess.
Born.
I was born. Come on. I was in my year 2 in my primary. Yeah.
So I've seen a few cycles before, and then I've always been in real estate in REITs. So I was the global head of real estate research for UBS and Merrill Lynch, and as well as running the broad management of all of research for Asia Pac. And then joined Cromwell when we listed the REIT here in 2017.
Okay. But I would say that it's a very interesting journey that you actually took a part on a management side, because as an analyst we are more siloed in a way, the way we work.
Yeah. So that's what I was. So I was a siloed real estate guy, and then in the old days you could do investment banking, advisory, ECM, DCM. And then they wanted me. I was the #1 rated analyst across all sectors in Australia, and they promoted me into Hong Kong to then try and lift 130 analysts in Hong Kong up to Korea. So I was in charge of Korea, Japan, Singapore, India.
Okay. And but at least that I know that you're not foreign to meeting the retail side and even the NC side in the future. So probably because the INSTI have a very different desk that handles things. And it's very. I will see how to broach more foreign ideas to them in the future.
Yeah.
Yeah. So I'll be in touch definitely in that context. And
Yeah.
we do
Good.
have all the biggest in town. Yeah.
Okay. Terrific. Well, next time we come up to KL, we'll reach out to you and maybe meet your institutional desk as well. Adrian, I know we've only got 1 minute to go. So how long do you want me to talk for? About 20 minutes? Is that?
I think you can keep to your pace that within 30 minutes, then we can do a bit more Q&A on understanding. We can spend more time on that. Yeah, I will do your introduction and also let me play the video.
Oh, you can do the video? Okay.
Yeah.
Good.
So I will do the introduction first of yourself and the video, then you can start later.
Okay, thank you, sir.
Let me admit this guys in.
Click across.
That to keep the Teams open. So just
I'll just click on the screen.
Go down or up. Is that okay? Or you want to?
That's okay. I can do this. Oh, is the mouse there? It's easier.
Hi, good evening, guys. Thank you for your time for joining us on our webinar on Cromwell European REIT. A brief introduction on Cromwell. Cromwell European REIT is the largest Singapore listed REIT with 100% European commercial real estate portfolio at 2.3 billion euro. The REIT owns more than 110 of freehold properties with a mix of logistic and light industrial and grade A offices in close on major gateway cities in the Netherlands, Italy, France, Poland, Germany, Finland, Denmark, Slovakia, the Czech Republic, and United Kingdom with an aggregate lettable area of approximately 1.8 million square meters and with a portfolio of more than 800 tenant customers. Currently, Cromwell European REIT targets majority investment weighing to the logistic and light industrial sector while also investing in the core office asset in gateway cities across Europe. And tonight we are very lucky to have Simon Garing, the CEO of Cromwell REIT, presenting to us on the company. And before he starts, I'd like to show you guys a quick video on Cromwell REIT itself. Yep.
The sound's not working. No sound. You can sit in here if you like. Yeah. Can you message him to say there's no sound? Doesn't matter. I think he's trying looking.
All right.
Thank you,
I'm sorry
Adrian.
that I noticed the sound wasn't working for the video. I was trying to resolve that earlier. But nonetheless, let's start the session with Simon. Simon, thanks again for giving us the opportunity in this session and also bringing us on a journey to Europe tonight. And yeah, do take the floor.
Thank you, Adrian. Thanks to Kananga for hosting me tonight. And it's a pleasure to talk to your investors, Adrian. Thank you. If we could turn to the slide deck, and I'll just run through a few pages for about 20 minutes and then open up for Q&A.
That sounds great.
Adrian, can you see that? Can you see the screen? Because I only see you. I don't see the screen.
I think you'll need to reshare the slides because when I was sharing the video, it got overwritten.
Okay, just bear with us.
Yep.
So Singapore is the largest REIT market in Asia ex-Japan with about 100 billion Sing dollars of market cap. And there are about 42 REITs listed here. The industry's been around for 20 years now. And it gives investors an opportunity to participate in real estate, not just in Singapore, but in the last 5 or 6 years, a trend for REITs like ourselves that invest in foreign property, but listed here in Singapore. And there's obviously some of the larger Singapore REITs, which are no longer just Singapore property, they've also moved offshore. So there's now about 12 to 15 REITs that have European real estate exposure. And I'll talk more about us specifically. So for an investor's perspective, you're able to derive a return from both an income yield. Currently, the sector is yielding around 6 to 6.5%. Our REIT, which I'll talk about in a minute, is currently providing a historic yield of about 13%. You can get access to a variety of real estate types, be it office or retail or hospitality or industrial and logistics. And I'll talk about sort of the advantages, particularly at the moment, of being invested predominantly in logistics and grade A office. We are very much regulated by the Singapore government and the MAS, as well as the Singapore Stock Exchange. We have to have a capital markets license, which means, again, we're highly regulated. And that's something, again, that a lot of international investors take comfort when they look at the REIT market here in Singapore. It is highly regulated. Still able to provide good returns, both from an income perspective and capital appreciation, although the point in the cycle at the moment is providing a good entry point because we've had 2 years of negative cycle as the world has worked through the higher inflation and therefore the rise in interest rates over the last 18 months. So we'll talk about all of that through the presentation, but I just wanted to start off by saying, we're listed on the Singapore Stock Exchange. There's 40 other REITs here. We're the largest pure European REIT, and I'll talk about the advantages there in a minute. So I do apologise for the lack of sound on the video, but just to recap, we are in 10 countries, but 86% of our exposure is in Western Europe. 2.3 billion euros, about 4 billion Singapore dollars worth of real estate. The average size is only about 25 to 30 million in size. That's the sweet spot for liquidity in Europe. You don't see a lot of major metropolis cities, perhaps in La Défense in Paris, perhaps obviously Canary Wharf in London, but generally the markets tend to be a lot more spread out throughout all of the cities in Europe. It is the second largest economy. While it hasn't been growing super strong in the last 18 months, in some respects due to the higher energy prices, the higher inflation, and therefore the impact from the rise in interest rates, But again, I wanted to demonstrate that now is a good time to actually be looking at investing into us and some of the other REITs, which have exposure to quite a resilient market. There's not a lot of new supply in Europe, which means, again, we are able to generate rent growth without new buildings coming in as soon as the economy starts to turn. We have a majority weighting to logistics. That's very important in the extent of the rise in the e-commerce in Europe. COVID has really accelerated the trend. So, for example, pre-COVID, Italy, only about 5% of retail sales were online. That's grown to about 12%. And to put that in perspective, more advanced retail economies like the US, UK are over 30%. So we still see there's some very favourable structural trends in logistics. As you'll see in a minute, it's a very resilient portfolio. We're at 95% plus occupied. We're still able to drive good rent growth, in part because almost every lease has an annual inflation indexation. So that means every year, as inflation is higher, we're able to get the higher rent growth. We also want to make sure that we have a well-managed balance sheet. So ensure that we keep our gearing, our LTV, below 40%. Even though our covenants are at 50, the board wants to put a good buffer and so retain some conservatism on our balance sheet. We've also got no debt expiring for another 2 years, and we're 94% hedged. So we're the highest hedged REIT in Singapore, which means if interest rates were to go higher, then there would be no impact on our interest expense line because of that very high level. And I guess our really unique selling proposition is, while I'm here talking with you in Singapore, we have over 200 staff in Europe. So these assets are locally managed by French people in Paris or Italians in Milan. This is very important within real estate globally, is to have those local asset management teams. That's been really helpful through the tough times, such as during COVID, where we were able to literally hold the hands of our tenants during that period. And we only lost about €500,000 out of 200 million euros of rent. So very good contract law. If the law says that, or the lease says you have to pay every quarter $100, the Europeans are paying that. So we end up getting close to 100% of our cash flow collected by those local team members. So we have over 1,000 leases. This means, again, diversification. We don't have heavy exposure to any one particular industry segment. So we're not overly exposed to the banking industry. We're not overly exposed to the automobile or the tech industry. So in the context of Singapore, almost 40% of Singapore's office tenants are finance tenants. So if you buy typically a Singapore REIT, you're going to have a lot of exposure to the banks and financial services companies, whereas in our portfolio, it's very much a very low and diversified industry sector. So again, building up that resilience of cash flow. We also don't have any particular tenant that is material to the bottom line. So again, in the worst case of a bankruptcy or a default, it ends up having almost no impact on our bottom line because we have so many tenants in our portfolio. So a very resilient portfolio. And this is shown on this chart, which is showing the occupancy since we listed in Singapore in December 2017. We've been able to actually increase it over the period as our local leasing teams, our local asset management teams have been able to reduce the vacancy. The second aspect here is we've also been able to get rent reversion. What does that mean? Well, that means that when we sign a new tenant at a new rent, it's typically higher than the passing rent of what the rent was previously being paid for. So again, people think, oh, Europe's pretty low growth. Why would we invest there? Well, from a real estate perspective, there is still good growth, as well as that high yield that I talked about at the outset. So good level of occupancy and good level of growth. The average lease has around 4.5 years of expiry. So typically our leases are between 5 and 10 years. Some markets are like 3 years. So again, 4.5 years gives you good visibility to the length of contracted lease that's already in place. We've kept about 74% of our tenants during the first half of the year. So that can be a good and bad signal. If you keep 100% of your tenants, it probably means you're not charging high enough rent. But if you only keep 5 or 6% of your tenants, then that tells you something's wrong. So typically we would look for tenant retention of between 60, 70, 75%, something in that range that tells you we have a very good relationship with the existing tenants and they're prepared to pay more to stay. So since listing in the last 6 years, I wanted to put up our distribution per unit track record. So we've been typically paying around 16.5 to 17 cents for the last 6 years. You know, the first couple of years, there was a bit of a top up of distribution with a payment out of capital. Then in 2020, again, during COVID, we topped up the dividend slightly to give investors a little bit more. And at the moment, you know, if you annualized our first half results, you know, you can see we'd be sitting at around that 15-cent mark. So we're currently trading at €1.30 and historically have been paying about 15 to 17 cents per annum of dividend. So that's what gives you that double-digit yield. So if you buy the unit on the Singapore Stock Exchange today for $1.30, then if you annualize that first half distribution, that gives you more than a 10% dividend yield. Why isn't it growing more? Well, in part because of the interest rates. So while our rents have been growing, unfortunately, so too has the interest cost. And there's not much we can do about that other than, as I said, hedge as much of that debt as possible. But all companies, not just real estate companies, all companies around the world are having to go through the refinancing and the retuning, if you like, as we move away from free money and now having more what I would call more historically normal levels of interest. One of the big questions in the market, of course, is when does the interest rate cycle turn, as the cycle always does turn, and how significant will that first round of interest rate cuts be? So that's something which we'll talk about on the next slide after this one. This slide effectively goes through the balance sheet and says we're geared at about 38%. Our interest cover is very high. That means for every dollar we earn, we can pay 4 times the amount of interest expense. And our NAV is roughly 2.3 euro cents per unit, or 1.4 billion euros. So if we're trading at $1.30 and our NAV is $2.30, you can see we're almost at a 50% discount to the underlying value of the assets. This slide here just demonstrates that we have no debt expiring in the next 2.5 years, with a 500 million euro bond expiring in November 2025, and then a whole bunch of debt beyond that period. And then you can see the hedging profile over the next 2 years, big high at 94%, and then even in 2025 at 73%. Again, that's the highest in the Singapore market. Okay, so that's a bit about the REIT and our track record. So when we think about Europe, we think about a couple of things. We think about the growing demand for logistics. I've already spoken about the rise of e-commerce. The other thing that's happened really since COVID and the geopolitical tensions has been the shift from a lot of industrial manufacturing companies and distributing companies to move from just-in-time inventory to the just-in-case inventory management system. That means that in the old days, you would keep as little inventory as possible, knowing that it wouldn't take long to get in your part from Vietnam or from Malaysia or from Colombia. Now, with the tensions and with some of the interruptions to global supply chains, that's created a lot more demand for warehouse space in Europe. And that little chart on the left-hand side of the screen demonstrates the vacancy rate by country, the 8 countries we invest in, is only 2.3%. So the markets that we're operating in, there's virtually no vacancy. So there's often more tenants looking for the space than there is space in that particular location. And in particular, what's known as last mile logistics. So this is the 3PLs, the UPS or the DHL or the FedEx that want to be very close into the population density. So our portfolio is skewed quite heavily to that last mile logistics, which ends up seeing quite high rent growth. The second structural benefit to our portfolio is the shift post-COVID from office tenants from B and C grade building to A grade. So when we get asked, well, what does work from home trend mean? One of the impacts is that employers are looking to lure their employee back into the office by actually having a nicer surround, having nicer amenities. The second driver to upgrading office space is obviously the much higher energy costs. So a more modern or retrofitted building will have much lower energy consumption, and that can be measured on a kilowatt per hour per square metre basis. So we're able to charge higher rents if we have a more energy efficient building and if we have better staff amenities. So that could be close to public transport, it could mean having electric vehicle charging stations, it could be particularly in the Netherlands, bike storage and changing rooms for everyone that rides bikes in Netherlands. And so we're able to see a big bifurcation in A grade office space relative to B and C grade. This is not like the US or parts of China where you see headlines of ghost towns or cities like San Francisco at 25% vacancies. If you look at the markets that we operate in, grade A vacancies in Milan is less than 3%. In Rome, it's less than 2%. In Amsterdam, it's less than 4%. So these grade A markets are, again, very tight. Again, you can probably imagine a lot of office buildings in Europe tend to be quite old. And indeed, only 20% of office buildings in Europe have what's known as a BREEAM certification, BREEAM. That's a certification to say this building has a modern amenity, is energy efficient. 80% or just under 80% of our office portfolio has this BREEAM certification. So the market is at 20 and we're at 80. So that again means that we have a competitive advantage to be able to take tenants who want to move out of their older buildings and into the more modern retrofitted buildings. On the negative side, higher interest rates for longer. That's certainly impacting our share price and everyone else's share price. But as Adrian can advise you, the world is looking at almost the end, if not the end, of the central banks from raising interest rates. And so with the expectation of that cycle turning at some point, the equity market will start predicting that. In the meantime, there are two negative impacts. The first is valuation. So real estate does have a correlation to interest rates. And so valuations over the last 18 months in our portfolio, as well as everyone else's portfolio, has fallen. Ours has not fallen that much, about 4 or 5%. Others have been much higher at 20 or 30%. And the second aspect on the higher interest rates, as I mentioned before, is our previous debt, we may have been able to lock in at 2%. New debt today might be at 6%. So the quicker the interest rates come down, the less impact on reverting to the higher interest rates occur. So if you're wondering why are distributions across Asia from a REITs perspective, the dividends, why are they falling? It's largely falling as this interest rate cycle has an impact. Again, at some point the cycle will turn and then we'll have that positive impact. Okay. I think there we go. That's going the wrong way. We have a development pipeline. So in our existing portfolio, we have a number of assets that are very well located. and we have identified over 250 million euros worth of development. So 2.4 billion euros of assets, but some of those assets lend themselves to being upgraded. And with that upgrade comes much higher rents and therefore development profit. So we'll do that within the REIT. Our sponsor is not a developer. So our sponsor is not building product to then sell into the REIT. We're doing the developments ourselves within the REIT. So unit holders, shareholders will benefit not just the income of the existing assets, but also benefiting from the development profits that we're achieving in this pipeline. Adrian, I might just run through a few more of these slides. This is going into a little bit more detail in our portfolios, but just very quickly, you can see very high levels of occupancy in our light industrial logistics portfolio, very good rent reversion. So that's in large part because the overall markets are so strong. We've put some slides up there that we released to the Singapore Stock Exchange as part of today's presentation. You could share that with your clients and they can go through these in more detail. But again, just to highlight, that top right-hand slide is the current and projected take-up of e-commerce. And with that comes more demand for warehouse space. That's then generated the market rent growth. So even as the economies have slowed, we're still able to get very high levels of rent growth. From an office perspective, it's not such a good story. I mentioned that we have a very high quality A-grade portfolio. We do have about 10% of our portfolio is in the B and C grade. So there is a tail of assets that post-COVID aren't working for us as well as the A-grade strategy. So we're currently in a divestment process. So we've recently announced a large sale that's taken us up to 190 million euros worth of asset disposals this year. So through this disposal program, we are looking to remove this sort of higher risk part of our portfolio and future-proof back to logistics and grade A. Specifically, Poland and Finland have not worked for us, roughly around 10% of our portfolio. And I can take questions on that later on, but generally the portfolio is in very good shape.
I think Simon, you have shared us quite a very interesting lens into Europe from how you have partly because of your pure European REIT, and it actually opens a lot of my I have so much question from understanding how does the consumerism of the Europeans and looking at your performance or even riding through COVID, it actually impresses me that you guys did fairly well surviving that period and as relatively come out very well. Just that the macro environment in the current global climate has been fairly too interesting. We have seen an all-time high in yields from the Fed, and partly that's why I think it's a very good time to look at the REIT sector as a positioning for investors to look into our accumulation kind of a strategy over a longer term. Because I mean, we can have this discussion, because I wouldn't be able to time the market, right? And looking at such attractive yields that you're actually dishing out is almost like closer to 12% based on my back of envelope calculation per annum. That's coupled with the so-called difference of what the year Fed is giving closer to 5. I still have some very, very good value proposition to actually look into that. And after today's Simon's your sharing, which actually gave me a very, very strong, better sense of the Europe market where how things are, and especially in the grade A office. Can you share a bit more on where do you see the trend for this logistic play where you will be positioning most of our portfolio up to which mark now you're currently sitting at 51%, and would you raise it higher to the exposure of 60, or and how are you going to manage your gearing now that it's actually on a rather healthy level? And after the disposal, what would be the gains and the usage?
Yeah. So good couple of questions, and obviously the observations, which I agree with. So from a logistics perspective, we'd like to get that up to over 60% weighting. Now, while our share price, our unit price, is trading at such a low price relative to our net asset backing and such a high yield, clearly, if we were to raise equity to buy more assets, it would be dilutive. The cost of equity is too high. So we are not going to raise equity to buy assets, okay, while the price is this low. So let's just take that off the table. So how do we get to 60% weighting to logistics? Well, we sell other assets. So we don't have an AUM target. I'm not paid based on growing the portfolio. I'm remunerated primarily by growing distributions and hitting ESG targets and staying geared below 40%. So my KPIs and my team's KPIs are very much aligned with the unit holder. Cromwell itself is the largest unit holder. Cromwell owns 28% of the REIT. We have a lot of private investors, high net worth investors. About 50% of our investors are actually based outside of Singapore, and around 21% of our investors are the international institutional investors like a BlackRock or a Prudential or an Eastspring or AEW, these sort of names. So we've got a really good mix. We're very well aligned. So we're not out there just to buy assets for the sake of it. We'll only buy if it's accretive over the medium term to both earnings and the overall value of the REIT's NAV. So we do want to get to 60%. We've got some developments and we've got some more sales to happen. Why are we so bullish on logistics over the next 5 years? Well, it's really that there's very little supply. And there's still modernization of warehousing going on. Some of our tenants are putting a lot of robots in. We have a 55,000 square metre warehouse near Venice where Ricketts, the very large FCMG company, makes Dettol and other hygiene products and has only 3 people in the warehouse working 2 shifts. It's fully automated. So there's a lot of work going on with inside of these warehouses that again means a lot more capital is going in from a tenant perspective. That means they're stickier. And at the end of the day, rent as a total cost is only between 5 and 8% of the total cost of being in a warehouse is the actual rent. So whether or not the rent is $100 or $120, if the tenant actually needs the space, they'll pay that extra rent. It's not the rent hurdle is not the deciding factor whether or not that 3PL wants to take up. So 60% is about where we want to get to. Your second question was around gearing. So we have a board policy range of 35 to 40% and an interest cover of 3 times. Why do I talk about interest cover and not just gearing? It's because the banks and the credit rating agencies like Fitch look at the ability of a REIT to be able to continue to pay its interest. So there are a number of Singapore REITs where they're getting very close to MAS limits at 2 times, 2.5 times. We're at 4 times. So we've got a very high level of interest cover. That's because even after the rise in interest rates in Europe, they're still 200 basis points lower than that in the US. So German 10-year bonds are at 2.8%, right? US 10-year bonds are at 4.8. So there's 200 basis points lower funding costs in Europe. Yet we can get high yields. So the average yield in our portfolio is 5.7%. So we're able to deliver a funding spread between the yield that we generate from the property versus the much lower bonds in Europe than in other parts of the world. So gearing to stay around 35 to 40%, and the asset sales have helped get us there. And then we've got more asset sales programmed, another 200 million, again, to fund the AEI. We can't keep borrowing, otherwise, as you pointed out, the gearing keeps going higher.
Yep.
So we have to sell assets because we certainly don't want to raise equity. So we sell assets, recycle that capital, put into these buildings where we're able to generate really good returns in.
That's a real eye opener that you actually shared on the warehouse in Venice. So in that context, you're actually telling us that given the high technological advancement in robotics in warehouse, right? When a client has incurred a heavy capex in your practical warehouse, does that mean that you have a bit more flexibility in raising your rents?
Yes, because if they were to move at the end of the lease, they would need to reinvest into the new building. So, our tenant retention, as I said before, around 74%, is reflecting the more level of equipment and capital that a lot of these tenants are putting in. We have a wonderful tenant in Paris. This property is 10 hectares. It's a massive site, actually within the inner ring of Paris. It's only 3 kilometers from the Champs-Elysees. We have a tenant there that sells plumbing hardware equipment like hammers, nails, bathroom accessories, because of all the tradesmen in the area renovating all of the condos in this northern part of Paris. You can use your app and you can order all of the things that you want, and then it's literally picked by the computer and delivered into your container that you drive your van, and you just go and pick it up. You don't have to see anyone. It's a drive. Think of it as a drive-through plumbing hardware store.
It's a McDonald's.
Yeah, exactly. So they pay us, to do the maths quickly, they might pay us 200 or 300,000 a year in rent, but they invested over 10 million euros of capital into this building.
So now that I got a better picture on these warehouses in Europe, right? Because my perception on smart warehouses mostly on a big platforms like your Alibabas, your
Amazon,
eBays,
yeah.
but seems like in the Europe market it's more specialized on they are more specialized on their product and their branding that these tenants are coming in rather than a big commercial arm that is.
We have both. No. To be fair, we have the big boxes. So Europe does have out of town 200,000 square meter warehouses. So what we tend not to have in Europe is the vertical warehouses as Hong Kong or Tokyo or Singapore. They tend to be single stories, but it's now becoming more common in some of the bigger cities to actually start to see more vertical stacking of warehouses. But no, I wouldn't want to mislead you. There are plenty of large boxes. It's just that we didn't find them of value. To buy a 15-year lease, brand new building leased to Amazon when money was almost free, people were paying ridiculously high prices for those assets.
Yeah.
And we stayed away from that.
That was during the boom, right?
Yeah, we didn't want to touch that. We wanted to be able to buy properties, and we did buy properties that had a bit of vacancy, needed a little bit of love, bring in some of these tenants that I've talked about, work with them through our active leasing teams to be able to work and improve the value of these buildings. And so that's certainly something that we continue to look at. Another site, many of your people your clients will know ABB, the big Swiss engineering company. Yeah. They actually make robots. So they're the guys that make the robots for food companies or make the robots and conveyor belts for consumer goods. They actually make and assemble their robots in our warehouse.
Oh.
We have Bialetti, which is the very famous Italian coffee urn and producer. So again, we've got a lot of robots in their warehouse. So It's something throughout Europe. The other thing is salaries in Central Europe. So one of the questions we sometimes get is, how come you're in Czech Republic? How come you're in Slovakia? These are very well educated countries, very close to Germany, in fact, border Germany, but their wages, their salaries are much lower than Germany. So you see on the border, you see a lot of these Central European countries with a lot of warehouses, forklift truck drivers inside a warehouse. They're now paid about half that of the China forklift. So salaries now make sense for a lot of the warehouse space that was being taken up in China. Those companies are now setting up in Central Europe. So they get closer to Germany. They don't have the geopolitical tensions and they can access much cheaper labor. So that's something that, again, a theme that we're able to invest in.
I would consider that as one of Cromwell's strength in enhancing and creating value for more of a niche property, and also to be able to offer it on the table to the tenants. I do have some questions on the chat where from City, where she's asking, how does this technological advantage does not only enhance the long-term tenant contentment, but also foster a longer relationship of satisfaction within these automated facilities?
Yeah, I'm not sure I understood the question. Could you just repeat that, Adrian? Sorry.
I think in some summarized version, I think is, how would it please the client to go for a longer term in terms of in your client relationships? Yeah, how would all this technological advancement would help?
Yeah, so as so there's a couple of ways of answering that. The first is a lot of these tenants want to know that they have a landlord, a property owner that is there for the long term, that they just don't move in and then the person they thought they were dealing with is sold off to some anyhow landlord. So you can imagine if you've invested, we have one tenant, Motorola. It's got their only data center outside of the US in our building. So you can imagine someone like Motorola says, well, actually, we want to know who our landlord is because we want to make sure that they keep the roof clean. They make sure that we've always got energy coming on site, make sure we've always got water on site. So having this very large portfolio and long track record gives the investors, gives the tenants confidence that we can be their partner. So if they're going to sign up for a 10-year lease, they know that we're there alongside them. The second benefit is at the end of the lease, being able to say to them, you had a good experience with us, please stay. And look, we'll charge you the market rent. But if they didn't like us, then our tenant retention wouldn't be so high. As part of our asset management program, we actually conduct an annual tenant survey from a third-party independent vendor. And so often we're able to rely on that sort of data and that sort of feedback to be able to improve our relationships with the tenants. Now, not every tenant is happy. There are some coffee shops, cafes that aren't so happy. The gym in the office building, if people are only coming into the office 3 days a week, the person that doesn't make money there is the cafe or the canteen or the restaurant. Or it may be during COVID, you might have had some tourism tenants. So if the tourism is down, then the tenant's not doing so well. So we had a bookstore, for example, in Paris that kept all their books, their library in our warehouse. But if not a lot of tourists are going through Paris, they're obviously not that happy. So I don't want to leave your clients under the impression that every tenant is happy. If you asked every tenant, are you paying too much rent? Generally they're all going to say, yes, we are. Just like if you asked, most of your staff, do you think you're being well paid? They'll all say, no, we're not.
No, man.
I've never seen a payroll, survey that people say they're happy. So, that's the experience of an asset management team, knowing, when to push in their negotiations, when to back off. And I made the point during my prepared remarks during COVID, at a time of desperate need, when the world was locked down, we only lost €500,000 of rent out of a €200 million rent roll. So that's a really good track record of being able to say, what is your relationship like with your tenants?
Yeah, I would say that's amazing actually, and it's a really really tough period that we all need to go through. I mean, I'm from the stockbroking side. I actually benefited from that, but even during the days when I'm required to get into the office, we do a lot more for those that actually is in the office. Yeah. So for you to be able to collect most of the rent, can you share with me a bit more, because on the dynamics in Europe, right? I'm just trying to get an idea that, is it more automation or is it more laborers? Because I have a question from Mr. Chow here that Central and Eastern Europe is actually experiencing high inflation, double digit inflation, while wages are actually increasing. I do get the benefits of most of these properties surrounding Germany, Slovakia, and stuff, where the workers are actually have a bit more of I wouldn't say discount. I would rather poise it where Germany has a premium in wage.
Yep.
Yeah.
Yep.
Yeah. So how would this, because I want to get an idea of, obviously you're sharing with me, to me, my perspective as an Asian that has not been traveling to Europe, I would take it as, wow, Italy, artisanal, Spain, and all these places are more artisanal in the sense, a lot of laborers work. But what you have shared with us is the technological advancement in even warehouses, and how these businesses has invested in your premises are actually very, very high tech. So just to get an idea.
Yeah, so you've got a few questions and observations in there, so if I can unpack them. So the first one on Central Europe and inflation. So remember, all of our leases, or most of our leases, have an annual inflation adjustment factor. So if inflation is 10%, then our rent goes up 10%. Some markets we only get, say in Italy, we only get 75% of the inflation. So if inflation is 10%, we get 7.5%. So every year we're getting access to that rent, to that inflation growth. So in some respects, from an income perspective, not from an interest rate perspective, but from an income perspective, we benefit from the inflation. So when people think of real estate as a hedge, they think of it as a hedge because of that rent linkage. In Singapore, when you sign a lease, it's typically only 3 years in length, and there's no adjustment. So if you sign for $12.40 a foot, so for 3 years, it's $12.40 a foot. But in Europe, we sign much longer leases, but annual inflation kickers.
Okay, that's interesting.
Yeah, the second part of your observation is actually a few months old. So because inflation is now coming down quite substantially, and in fact, the numbers that just got printed yesterday, it's now down to 4.3%. But even in Poland, where inflation was in double digits, their central bank 2 months ago started cutting rates. So 2 months ago, the Polish central bank started cutting rates. So inflation, particularly with the impact over the last 2 years of the high rates, that's really starting to see the market starting to anticipate the sort of the end of the interest rate increase cycle. And in fact, in some markets, as I've just described, they're starting to cut rates.
Okay, that's very, very. I mean, tonight's session has actually gave me a very, very different, broadened my mind a lot, and I'm just curious that I have another question where it actually asks points on portfolio diversification around Europe, right? How are you gonna manage all these ever-changing political risks and economic conditions? But what actually intrigues me more is, how did you manage your team so efficiently out of Singapore?
Yeah, so what we didn't want to do was create a portfolio that was only in 1 or 2 European countries. And so we did want to provide sort of a pan-European exposure, so that indeed, some countries, in some respects, Europe is homogenous, in some respects it's not. So it has its own, each country has its own government, each country has its own tax policy. So there's still some elements of where each country is slightly different, but generally under the umbrella of the European Union, it's relatively consistent. So when you see the headlines of, a right-wing prime minister being elected, or strikes in France, or issues in the Netherlands forming a government, generally this is the normal way of life in Europe, and we just wanted to create a more diversified portfolio so that we didn't have to really worry about any one individual tenant or one individual market, or one individual political posturing that may go on in Italy, often from time to time. You made a comment then about, Italy being artisanal. It is the 4th largest economy in Europe, and it is a net exporter. It's got a very strong pharmaceutical industry, good tech industry, good ag industry and ag tech, and it still makes ships. It's got a steel industry. Obviously, that's not a growth sector. But really, where Europe at the moment is benefiting from is in bio and pharmaceuticals. So, a lot of your clients will know LVMH is one of the largest European companies. They'll know Shell is one of the largest, but they probably don't know that the largest company in Europe right now is a Danish pharmaceutical company. So we have a very large portfolio in Copenhagen, in Denmark, that's really benefiting from the resurgence of the pharma industry. COVID has been, and modern medicine has been, a key strength of Europe. The other good tenant that we have that's growing in our portfolio is ASML. So what Europe is trying to do at the moment with the sort of the concerns around Taiwan is, by 2030, Europe wants to have 20% of the world's semiconductor industry. At the moment, it makes about 5 or 6% of the world's chips. And a couple of months ago, they introduced a $42 billion package to take that up to 20% of the world's chip. So what does that mean for us in real estate? It means there's another growth engine in the economy in Europe. But if we look at a recent Savills report, that sort of investment and that type of industry requires almost 11 million square meters of new warehouse space, both of the input goods to store somewhere and then the outbound goods to store somewhere, as well as the manufacturing process. So these type of new industries are also providing a tailwind for both, not just logistics and light industrial, but also for office.
This means we need to work harder in Malaysia to actually fight with Europe now for the semiconductor industry.
Well, I mean, unfortunately, the world is worked out that, if you were looking at the German car industry in 2021, there was a 35% reduction in the volume of cars being made in Germany. That wasn't because demand dropped 31%. They just couldn't get chips. So we've got people here in Singapore that bought Mercedes with rather than waiting 18 months, they were happy to have the old seats where you wound the seats up. Mercedes were prepared to fill orders without having an automatic seat adjuster.
Oh dear.
They drew the line on the window, the old window wiper. So Germany has worked out that it really needs to move away from TSMC and Samsung from a chip perspective. The other big industry that's happening, remember, Europe is leading the way in green energy, in renewable energy. 35% of our portfolio is actually our electricity is sourced from renewable sources. So that's from the grid. So from the grid, you can get wind, solar, hydro, even nuclear power in France in particular. So with 35% renewable energy, there's a push by governments for us as property owners to install more solar panels.
All right.
There's a big push for us to reduce our greenhouse gas emissions. So we've signed up to the Paris Accord, which means by 2030 we have to reduce our GHG emissions by 40%. So the governments have worked out, well, if we're going to install this discipline on us to supply more PV, where is the world's PVs being made? They're being made outside of Europe, being made in China. We should really encourage a local industry. So it's crazy that we're exporting all this capital to buy back PVs when we should be doing it ourselves.
Touching on the green energy, I've been following it quite a bit. You guys in Singapore also have a big manufacturing arm there. Rather than just on the topic on PV, what's your thought on battery manufacturing?
So Germany has a very well-established chemical industry, hundreds of years. Some very famous chemical companies like BASF. With combustion engines being banned from 2035 in Europe, they're really having to fast track their own battery. We're expecting to see a number of major investments, not just from Tesla batteries, but from the local German chemical companies.
Okay. Because from a commercial standpoint or even residential standpoint, if I were able to farm from the solar perspective, from a residential standpoint is I couldn't store it, and if I can actually tap into this, could it be possibly that we can actually create a private grid of battery banks? I mean, it could be far-fetched.
You're now taking me way out of my comfort zone in discussion. So all I can contribute to that conversation is if they want warehouse space, there's not much available.
Okay.
But what you're touching on, is a bit like data centers. There's incremental change or structural shifts in technology leading to new product cycles still has a real estate bias.
Yeah.
So there's still requirement, if you think about data centers, and we have 2 of them in our portfolio, they still need a property owner. They're still encapsulated in steel and concrete and have to have a flat surface. So, the more we use technology, and you've seen this big step up with AI and the share prices of NVIDIA, et cetera, going through the roof, that still requires real estate. It still requires energy. It still requires water.
All right. I believe that now the trend on the topic on ESG, right? How distinctive are you guys in this direction in propelling yourself in to be one of the leading REITs? Yeah.
I'm looking at my investor relations manager just off camera here, because normally we would have a whole page on ESG and we would have all of the medals and trophies, and I can tell you that we're AA MSCI ESG rated. There's only 3 REITs in Singapore that have an MSCI AA rating. We were just awarded 85 GRESB points. That's the global real estate benchmark. That places us 2nd in Europe amongst all of the diversified REITs. We're the highest awarded REIT with the local Singapore Stock Exchange and the National University GIFT Award. So that's the governance index. So when we think of ESG, we don't just think about reducing energy, water and waste consumption. We really hone in on governance. And so governance really sets the overall arch, the framework. And really our purpose, our principle, as I've mentioned at the outset, is really to drive returns for investors. And so when you think about the environment part of that, yes, we want to save the planet and everyone wants to be part of that. But really, why do we reduce the energy consumption in our buildings, it's ultimately to reduce the costs and expenses for our tenants so that they're prepared to actually pay us a higher rent. So it's actually good business sense to focus on the E, but from a governance perspective, it's really about driving returns for investors.
Simon, I totally concur with you in that context, and I always thought that ESG is named wrongly by sequence. I always believe the G comes first, so it should be GSE, because when you have a very strong and good governance, your social will become better, and essentially it'll trickle down to the E. That's my thought, and I totally concur with you. So the next question is, I love how your KPI is being structured, that it's not based on asset size, it's all based on shareholders' return. And how are you, and the next, where I'm pointing at, I think that worst is over, because from my standpoint, that you are doing all the right things for as a REIT player. You're actually very good at it, but I would think it is a bit of luck factor and market timing, where unfortunately, when you guys are listed in a very short period of time, COVID landed, the world was in a flux, and now the world has reopened, but the problem is actually on the interest rates, and which led the funds flow to be in a very different direction. Hence, the share price performance has been trying to perform, but it was always hit by all these external factors. So from a standpoint that probably from a business standpoint, can you point that the worst is over and you're actually seeing some light? And then the follow-up question is, now that we are all anticipating on a potential cut in rates, just now you have shared with us that if they raise it even more, because 95% of your debt is actually well hedged, right? Can you capture on
the way down?
Yes.
Yeah, so some of our hedges are actually caps and collar derivatives, so we do benefit in a rate cut. The other thing that we will benefit from is, I'm just trying to get to the page, this one here. You can see with this line, this is our hedging line. So in 2025, we'll certainly be able to pick up more of that impact, on that benefit. So are we at the bottom? Close to it, I would say, from a cycle perspective. There's always going to be a bit of a lag effect that comes through the actual portfolio, but typically share markets will start to rise even when the sort of the tail of the down cycle is still coming through the actual results. So February last year, as we were still doing, coming out of COVID and we were back to sort of a more normal playing field, we were starting to trade at a premium to our NAV. We were up at around €2.40, €2.50. And then Putin invaded Ukraine, and that saw our share price fall quite materially as investors started to worry about, the ramifications of a Ukraine war, the ramifications. Remember, over a year ago, we were all worried that millions of people in Europe were going to die through the winter because there was no gas from Russia, there was no oil from the Middle East. Now, we got through that winter and no one died. And Europe was very self-sufficient and has moved off the Russian gas very quickly. And then the interest rates started to increase. So, if you think about, almost the kitchen sink has been thrown at us.
Yeah.
And we just announced a 7.8 cent divvy for the first half. You saw the occupancy slides at 95%. So, if that's not a resilient portfolio, I don't know what is.
In fact, I find that is surprisingly that investors are actually holding back in with you guys, because for what you have done with a very strong occupancy rate of 95%, and you're not actually rushing yourself into the next big thing, fighting for the next big box warehouse. I think you have a very good sense in how you want to position yourself, and in with the direction of driving the EPS up for the shareholders. So I'm actually trying to get a gauge on, even from your meetings on with some other investors, what would be their major concern, and yeah, I'm just trying to
So the major concern from investors, and this is why a lot of the foreign REITs are trading at discounts, is because we're exposed to the higher interest rate markets, and so investors are trying to ask, if I look at the interest rate curve, when will this play out? At what point do you have to start rolling your hedges? A lot of our debt is still at sub 3%. So even if interest rates come down a little bit, we still have to go up. Okay. So the question, the investors aren't quite sure when do we start having that even renewal on debt versus what we currently have in place. So that's the first thing. The second thing, which a lot of the foreign REITs in Singapore have, is the question about valuation. So our portfolio has held up well in the last 18 months. We're only down about 5% in total.
Yep.
Okay. There are other REITs, particularly US office REITs, that their valuations have fallen 20%.
Yep.
Right. So investors are worrying about this page, which says your net gearing is 38%, but if you lost another 400 million or 300 million of value over the next 12 months, as we're getting towards the bottom of the valuation cycle, how much higher will your gearing get to? Will you get to your covenant level of 50%? Now, on our sensitivities, our valuation would need to fall by 20% before we hit our covenants. Right?
Okay.
So there are some REITs that are trading at 80 or 90% discounts to their NAV because they've breached their covenants, because their real estate prices fell a lot more than what we're seeing in our portfolio. So until we can kind of get to the institutional mindset of, okay, the worst is now behind us, you don't have to raise equity, you're a million miles away from your debt covenants, we will come back in. So I feel we're in this sort of window of opportunity for slightly higher risk takers to say, you know what, even if it's not the bottom, it's close to the bottom, and even if they have another 5% off the value of their portfolio, excuse me, they're still well within their debt covenants. And we were really pleased last week that Fitch came out with their annual review and report on us, and they reiterated their investment grade rating with a stable outlook. So we know that our share price bumped last week, partly as a result of people going, okay, well, that's the credit rating agency saying, we've looked inside the tent, we're happy with what we've seen, we're not downgrading, we're leaving it stable. Whereas a lot of other REITs have been downgraded. So for us, that was a really important third-party validation of our strategy and of our portfolio.
Yep, because I was an equity analyst, and bond analyst works in a very, very different way.
Yes.
There's so much detail. You're basically naked in front of them.
Yes.
Yeah. While on the equity side, we are actually trying to push forward on our potential hypothesis of growth and stuff. Yeah. So I think with Fitch reformation is good.
There's more thematics, Adrian, isn't there, in equities? I mean, you talk to themes a lot.
Yes. Yes.
And the days of the NVIDIA, the AI, that theme is playing out. But other more traditional themes such as real estate have been left behind, and at some point the value starts to become compelling.
Yeah. Would you mind that if I were to quickly flash a chart for Cromwell?
Sure.
All right. Let me do this. All right. I think we are at 9 p.m. Simon has shared us a very great insight into how the European market is, and I actually very intrigued with this company now that he has actually gave us so much thought about. So this is where I come in. This on Sing dollar. So I was a fundamental analyst, Simon, but now I'm more technical than fundamental. I forgot how to read news lately. So
you got your stochastics up there. What's the MACD looking like? Have you got that loaded?
No, I'm very well. I'm just used to stochastic. So I will just take this on a journey of value proposition. Looking at how Cromwell is actually dishing out closer to 12% yield, closer to our approximation 11 to 12. We put in a band of to be safe about 10 to 12% yield. And I asked myself this question as Simon actually was giving his presentation. Is there any better timing than now to actually start accumulating, or should I actually wait? Is this investment interesting enough? First, it Tick My Box is actually very interesting because how you have shared on a 95% of your tenant mixes are all very, very good tenant names that you actually highlighted, and a way of automation even in Europe and how they're actually going through. So what I'm seeing here is a weekly chart, and on a weekly chart, first, the stochastic is actually on the oversold zone. I'll put a line here. It's called study and study. Oversold to almost like less than 10 on a weekly basis. Secondly, the recent low is actually at 180. Now it's actually trading at 187 Sing dollar. Probably sophisticated players can do an arbitrage between euro and Sing dollar, but I'm not that sophisticated. I'm more simpler, just like everyone here tonight. I think that if I were to adopt of a bit of accumulation strategy, I actually would want to buy this by taking a start here. It's actually now or never, because looking at how Fed is going, it is gonna turn. It's gonna turn. And looking at how the chart has actually bottomed out, I think it's a very, very rare window of opportunity that we do get these opportunities. So value proposition, I mean, I might be sound offensive to Simon. What if I accumulate now and it actually goes up to about 210, 225? I can actually sell it a portion and I keep a portion. So that makes sense from a so-called quasi-trading and also investment perspective, that, I mean, we are actually in a very, very turbulent time that we're actually living in. And I think for investment perspective, where we want to see comfort is how we can better manage our risk. And I think that Cromwell, how they have weathered through COVID in a European country where labor laws and all this is something you shouldn't be messing with, where they have very strong regulation, and how they have championed stuff. I think they have actually did a very good job. And in fact, I was almost tempted. Okay, I'm gonna ask it anyway. Are you gonna move out from Europe into Asia?
No.
Yeah. So that's
because
where
I tell you why. Because our teams that have been there for so long, they live and breathe their own cities. Cromwell does not have teams like that in Asia. So
the localization content of the team,
very important.
Yes.
Real estate is location, location, location.
And the people.
Yeah. So no, this is, we may sell out of Finland, we may reduce Poland, but we will stay within Europe.
Yep. So that's this actually where I share my perspective, and yes, I definitely thank Simon and team for actually staying up this late to share us this perspective into Europe. I'll definitely actually raise it with my team internally to see if we can promote this further. But for the night, I would ask that is there any more questions that that we can take, or anyone that want to raise anything? For Simon and the team, they are actually quite ready. And if there's none, we can.
Thank you.
I can take it offline with Simon anytime.
Anytime. You can find us here in Singapore with my team here anytime. Adrian, thank you very much for your time. Thank you very much for your clients and investors for participating. I really appreciate the interest, and we try and get to KL a few times a year, so we'll certainly keep in touch and work through Dimas and Elena. Thank you, everyone. Have a good evening.
Yes, thanks a lot. Thank
you.
you, Simon. Thank you, Cromwell's team, Dimas and Elena. And yes, for our guests, thank you so much for tuning in. See you guys. Good night.
Good night.